Markets are back at all-time highs. S&P, NASDAQ, they're back at all-time highs. So why aren't covered call ETFs fully recovered? Why aren't covered call ETFs also back at all-time highs? Guys, welcome to the channel, by the way. Welcome back, your number one source for income-oriented investing. I've been getting these questions a lot lately. I've gotten them before at previous market time highs, and I'm assuming I'm going to get them at the next market time highs. The honest answer is, the best answer I could give you is you're not really looking at it properly, or don't really understand how these funds work and what they're designed to do. That is the honest answer. If you were to understand, everyone, fully how covered call ETFs work, what they do, you wouldn't have this question. But luckily, maybe you're a bit newer to this type of investing. Luckily you have me, you have this channel, and you're subscribed to this channel. Or are you? Make sure to subscribe to the channel, guys. So this is the topic we're gonna focus on today, and hopefully by the end of the video you're gonna understand, and I'm gonna really show you why this is, or why it seems like it is. So let's get to it. Before we continue, I'd like to tell you that Moomoo is Canada's first AI broker with their new Moomoo AI, and it's actually better than ChatGPT for investing because the answers are powered by their massive real-time market data and trusted financial news. So like you could see on your screen right now, if you like doing research on individual stocks, fundamentals, things like that, you can now use AI within the Moomoo broker to ask the questions and save time on doing research. Really, really cool. And by the way, of course, as usual, Moomoo has a bunch of really cool bonuses when you open a new account. For example, right now, if you open a cash account and you deposit $100, you'll get $50 cash back. If you deposit $5,000, you'll get $300. Out of the $300 though, you have to spend $100 doing options trading, but you do get $200 where you do whatever you want with it. Also, if you sign up 60 days, 2 months of no commissions, and for the first 2 months, you have 6% annual interest on cash just sitting on your account, just sitting in your account. So guys, if you're a Canadian resident, you want to try out this AI feature, you're interested in checking it out, you want these bonuses, just open a new cash account. Remember, you could have as many cash accounts as you want. Deposit that $100 for $50, or deposit $5,000 to get at least $200 where you could do whatever you want with it, and try it out. Just make sure you use my link. You have to use the affiliate link in the video description below. I'm going to put it right at the top of the video here. You got to make sure you see that PII X Moomoo at the top when you open your account. So check it out, guys. All right, everyone. So two major points I want to get to in this video. One, if you're still having this question, it means you haven't fully understood how covered call ETFs work and what they actually do. So we're going to focus on that a little bit, and then I'm also going to focus on another point, and then we're going to go through a bunch of examples. All right. So the first thing I will tell you is that I've kind of already covered what I'm about to say in a full-fledged video, which is actually, you know, if you click on the name of my channel, it's actually the video I made on my homepage called The Honest Truth About Covered Call ETFs, the video that you're seeing here about a year ago. And what you need to understand about covered call ETFs is that what they basically do is that they give up upside. You're capping your upside. You're giving up upside for that income. So of course, when markets are, go down, up and down, and then they're at all-time highs, covered call ETFs will never capture the full upside of that. Yes, they have a great yield. They have a consistent monthly income, which is great. We all love, but the total return, everyone, is never going to beat the underlying. So for example, and that's what I talk about in this video, you could check it out. So S&P 500 versus the S&P 500, an S&P 500 covered call ETF, no leverage or anything like that. The covered call, the S&P covered call, or whether it's a NASDAQ 100 covered call ETF versus the NASDAQ 100, the covered call version will never, ever, ever, ever outperform or beat the underlying. Why? For two main reasons. Because the S&P and the NASDAQ goes up over time. They go up most of the time, right? Over time. And when you're doing covered calls, you're giving up some upside. So of course, you're not going to capture the all-time high. You're going to miss out on some of that upside. That's reason number one. Reason number two is that covered call ETFs also have higher fees than just holding the S&P or the NASDAQ, because there's options, they're harder to manage, there's more work that goes into it, right? So you might, in Canada, the typical fee is 65 basis points. In the US, some of them at 35 basis points, like GPIX, NEOS, and TSPY have 68. Yield Max has 99 basis points. Either way, they're always going to be a lot higher than just holding the index, which has almost 0% fee, right? Like a VOO or an IVV. And in Canada, it's the same thing, VFV, whatever. So for those two factors in this video, I say, guys, that a covered call ETF will never outperform the underlying over the long term. Now, of course, if you know, short term it can, right? If there's if the market is flat or down for 3 months or 5 months or 6 months, the covered call ETF will outperform, because when there is no upside, right? Covered call, writing covered call means you're giving up upside for premiums, for money, for cash. When there is no upside, you're gonna outperform, because those premiums, there's no upside, you're not giving up anything. That could happen in the short term, but over the long term, the S&P, the NASDAQ goes up over time. So you're not going to outperform. You are going to underperform for that reason, plus the fee factor as well. That's my personal opinion, but I think it's a well-educated opinion. Even Ben Felix has a video basically saying, I think the same thing. He called it the income illusion, with a lot of super fancy words and fancy language. But guys, that's what it basically is. If you understand covered calls, you're not going to ask this question. Now, another very, very important point, and I can't stress this enough, guys. I've said it a billion times, okay? A billion times. I'm going to have to repeat it a billion times. Every time I say it, I have more hair that falls off. Eventually, I'm going to have no more hair. But anyway, stop looking at stock charts. You have to stop looking at stock charts when you're judging if a covered call ETF is back at all-time high. You have to look at the total return. Again, stop looking at stock charts. Look at the total returns, because the income, the big income that these covered call ETFs give, you will not see that translated in the stock chart. Every month, that income that you get, the income that comes out of the fund on the X date, think of it like that amount is coming out of the stock chart. That's why the stock charts don't look so good, because you're not seeing the capital or the income coming out and being given to you as cash. So stop looking at stock charts, which you're only looking at price return. Look at the total return, which includes the price return and those dividends, whether they're reinvested or not. That's why I always use that website, the Dividend channel, where you could compare to ETFs. And we're going to go through a bunch of examples now, guys. There's no better way of learning than looking at examples. And I'll take a look at, really the easiest things you could do is look at the index ones, right? The S&P 500 covered call ETFs versus the S&P 500, NASDAQ, et cetera, et cetera. So we'll start with HYLD. So guys, you see it here. And again, you know, for the stock chart, you see this, you know, the all-time high, let's say it's about $14, little over 14. April happened, market back at all-time high. What's going on? HYLDs didn't recover. Now, HYLD is not exactly the S&P 500, but let's treat it like it is, okay? For now, for this exercise. So, hey, 14 something, right? A little over 14, 1356, but the markets are all-time high. Why isn't HYLD at the all-time high? Why hasn't it recovered all the way? USCL, same thing. USCL is officially the Global X Enhanced S&P 500. I'm doing the ones with the 25% leverage. The ones without the leverage will never ever, in my opinion, beat the underlying. But we're gonna continue with this example here. 24 something. April happened. Markets back at all-time highs. USCL is only at 2168. What is going on? Why isn't it back at 24 or whatever? QQCL, the NASDAQ 100 covered call ETF with 25% leverage. Same story. 25, I think it hit 26 at one point. Markets crashed, whatever, in April. Trump tariff, blah, blah, blah. back NASDAQ 100 back at all-time highs. This is at 23. Why isn't it back at 25, 26? It's because you're looking only at the stock chart, guys. You're not looking at the total return. Okay, so what do I mean by that exactly? Well, between this time, 14 whatever, and 1356, this is, 4 or 5 months, HYLD paid a dividend out in March, April, May, and June. 4 dividend payments have been paid from this point, 14.5 cents each. Those are not shown in the stock chart, guys. You have to, if you're just looking at stock charts, you're obsessed with stock charts, well, then you're gonna have to do 1356, what the price is now, plus 14.5 cents, plus 14.5 cents, plus 14.5 cents, plus 14.5 cents. Okay, 14.5 times 4. Okay, so if we do 1356, well, actually, let's do 14.5 cents times 4 first. That's 58 cents. So it's if you're looking at the stock chart, you're gonna see 1356, but it's not. It's 1356 plus the dividends they gave out, which is 58 cents. So 58 cents plus 1356 is 1414, which is, you're there. So HYLD pretty much is back at the all-time high. You're just not seeing it with the stock chart. And if we do a total return comparison, which includes those dividends, which includes everything, let's do it, guys. We're going to do HYLD versus VSP, which is the Vanguard S&P 500 in Canada hedged at the Canadian dollar, not VFV, because HYLD is hedged at the Canadian dollar, apples to apples. So HYLD versus VSP starting in January 1st, 2024, which is when HYLD got transformed and turned into HYLD 2.0. It's actually February, but I'll just leave it January 1st. If we do a total return comparison, you see that HYLD is outperforming, is beating VSP. This is with dividends reinvested, and here we're simulating with dividends, not without dividends being reinvested, but it's still outperforming, which is absolutely incredible. So it's still counting the dividends at the bottom, but it's just not simulating that you're reinvesting, and at the top it's simulating that you're reinvesting them. So what does this chart tell us? What does this evidence and total return tell us? HYLD is outperforming VSP, so it is back at the all-time high. It is. Okay, we could do a similar exercise now with the USCL versus VFV. So if you do USCL versus VFV, because USCL is not hedged to the Canadian dollar, so we're going to do VFV this time, and we're going to take the same date, you could see that it's almost there. It's pretty much there, almost there in terms of total return. Not quite. Now, this is with dividends reinvested. This is with dividends not reinvested. So you see that it is not outperforming VFV. It's not outperforming the S&P 500. It was at one point here before the April crash. Maybe it will in the future, but right now it isn't. But it's very, very, very close. It's doing its job. It could be for a number of reasons. Maybe they wrote too many cover calls, a little bit more than HYLD. It could be the strategy, it could be the currency. There's also higher fees. Remember, USCL has higher fees. I'm not telling you here that USCL is always going to perform either better than VFV, but I could tell you that it's going to perform similar always to VFV. Why is that? Let's just do QQCL for the last one. QQCL, which is the NASDAQ. So of course, we're going to compare to the QQQM of Canada, which is QQC, by the way. BMO has one too, ZNQ, but we're going to do the Invesco one just to make it 100% official here. Same type of story. It's pretty much there. It's almost there with dividends reinvested. Dividends not reinvested, but still counted. It's not there. So QQCL, USCL, HYLD, HYLD is actually beating the underlying, but they're performing very, very, very similar. They're doing their job to the underlying. Now, why is that, by the way, if Adrian, you said that cover call ETFs will never beat the underlying? It's because of the 25% leverage. All three of these are leveraged 25%. Remember, guys, this is why I invest in things that have covered calls and 25% leverage, because I love the income, but I'm also, performance and total return is also very important for me as well. So basically what happens when you add covered calls to something, you're going to lower your total return over time because of the two big main reasons I told you. Covered calls means you're giving up upside, plus they have higher fees. But Hamilton and Harvest are the first ones who came up with the idea, let's try to mitigate that trade-off. Let's try to get it. How can we get the total return a little bit up so that it matches the underlying? The answer and the key seems to have been 25% leverage, right? So 25% leverage, you're increasing your risk. Covered calls lowers the risk. So you have similar volatility, similar risk, which means similar performance to the underlying. That's why on HYLD's website, you see this here. I wish everyone would put it, a higher yielding alternative to the S&P 500 with similar volatility, similar risk, basically, because of the 25% leverage. If they didn't have the 25% that leverage, if they didn't have it, they would say with less volatility. So in the US, there's plenty of S&P, NASDAQ 100 covered call ETFs. There's basically none of them are outperforming the indexes because none of them have 25% leverage. But Rex has been the first manager to launch 25% leveraged and covered call ETFs, but they don't have index ones. They did it on Coinbase, MicroStrategy, Nvidia, Tesla. They're calling it the growth and income ETFs. So they're covered calls with 25% leverage, 1.25x. So hopefully more and more come out so we could at least have a chance to mitigate the yield return trade-off in the United States. I'm confident that's going to happen, but this is why I invest in the Canadian ones. There's other reasons as well, non-resident tax purposes, which I'm not going to get into here, but this is why I always say my favorite format, covered calls and 25% leverage. So you could at least get similar performance, not identical, sometimes a little bit better, sometimes a little bit less, to the underlying, which in this case is the NASDAQ 100 or the S&P 500 or the S&P 500 hedged to the Canadian dollar in the case of HYLD versus VSP. So hopefully that clears up why you're not seeing the covered call ETFs at all-time highs. If you're looking at ones without the leverage, like a USCC, for example, and you do a similar exercise, right? USCL, we could do the same thing we did with HYLD. It was at all-time high 23, 24. Now it's at 21.68. Yeah, but guys, USCL has in the last 4 months has given out 25.5 cents, 25.5 cents, 23.5 cents, 25.5 cents. You need to add that to the last stock price to see. Now it's not going to be back at 24, but it should be close to 23, 23.50, right? Similar. It's doing its job. QQCL was 25.26. Now it's at 23. Yeah, but it gave out in the last 4 months 4 dividends of 29.5 cents, 29.5 cents, 27.5, 29.5. So you have to add that to the stock chart if you're only looking at stock charts. But for the love of everything that is holy, guys, if you just want to stop asking these questions and you want to know exactly what's going on, always look at the total returns, not the stock chart, not the stock price return. Total return includes everything and is net of fees. That's why I love this website. You have one for Canada, which could compare to Canadian symbols. So obviously they have to be apples to apples. You got to do NASDAQ 100 to NASDAQ 100, S&P to S&P. So in the US, they have Dividend channel as well. They have one for the US. So you could do TSPY versus VOO, because VOO is the Vanguard S&P 500. TSPY is an S&P 500 0DT covered call ETF. If we do the total return comparison, you see that TSPY was outperforming it without leverage, which is amazing. I think he will eventually outperform VOO. That's my prediction, but it could take a while. But you see that it's not back at all-time highs, or it's not outperforming the S&P 500 because there's no leverage, and covered calls means they give up Upside, the same type of deal. What we could compare to VOO, SPYI as well, right? SPYI is an S&P 500 covered call ETF. It will underperform VOO, and it will continue to do so. That's just how it's designed. It's a feature, guys. It's not a bug. They're giving up upside, and if you're doing covered calls, means you're giving up upside. If you're giving up upside on something that goes up over time, you're not gonna outperform the underlying, which doesn't write the covered calls. GPIX, same thing. S&P 500, that doesn't even do a lot of covered calls, is underperforming as well. It's performing better than SPYI. Why is that? Very easy, because they're writing less covered calls. They're giving up less upside, right? So in a 3-month period where the market is flat or down, most likely SPYI will beat GPIX because they're doing more covered calls. If you're doing more covered calls, you're getting more premiums. When the market is flat or down, there's no upside, you're gonna win. But over time, over the long term, if the S&P goes up and the NASDAQ goes up, which it has been and it will continue to do most likely, covered call ETF will always underperform. And again, stop looking at the stock chart, because it doesn't show you all those dividends that are being given out, those big dividends. And to be fair, they're not showing the Vanguard dividends as well, but those are so tiny. VFV, TSX. VFV actually has a dividend, but it's really tiny. It's not a big impact, right? So that's why for index funds, the charts just go like this, but the covered call ones are mostly flat. Again, guys, I'm repeating myself, I know, but this is a concept you need to understand, that you cannot look at stock chart to judge these funds. You have to look at total returns. You have to understand what covered calls do, what they mean. And if you want similar performance like me, you love the income, you want similar performance of just holding the index, you're going to have to get the 25% leverage version, because it's, in my opinion, it's one of the only ways that or some sort of super genius option strategy, which I think the only one that could potentially do it is a zero DTE strategy. And I think TSPY has the best one, in my opinion, right now, which is, why TSPY has been beating VOO for the longest time. Not anymore, but I think it will outperform VOO. But imagine TSPY with 25% leverage. I'm 99.9% sure it's going to beat VOO if they come up with that. I hope they do. And for the record, I've talked to all the US fund managers I've been on my channel about doing the 25% leverage. I've pretty much told them it's a good idea. It works. Look in Canada, the results speak for themselves. You might not get exactly better performance, or you're not going to beat it, or you're not going to get the exact performance, but it helps to mitigate, right? Look at QQCL versus QQC. If you just do QQCC instead without the 25% leverage, you see the difference. It's underperforming by a lot, while QQCL is underperforming just by a tiny bit and might even beat it at one point like it did. So give me a thumbs up, guys. Hopefully this video was informative for you. Again, you got to understand what covered calls ETFs, what covered call ETFs do, what covered call means. You're giving up upside. So of course, if something goes up over time, you're always going to underperform. That's point number one. Point number two, please stop looking at stock charts. It's like judging a book by its cover. It makes no sense. Do not look at the stock charts, because the dividends or the income that is given out to you that comes out of the NAV price, which is basically the stock price, is not shown here. All right, give me a thumbs up. I would really appreciate it. Have you learned? Is anything still not making sense to you? I know I'm rambling on a bit, but this is if you want to be an income investor, you want to invest in these covered call ETFs, you got to understand what they're doing and how they work. And if you do, you'll never have that question ever again. See you next time, everyone.